All right, folks, this is actually the last part for Chapter 4. We're going to go right into the problem session because there's only like one slide left. So, why did we make these adjustments? We mentioned this before. Oh, I thought I turned you on. Highlighter. Why do we make these adjustments? Okay. To ensure that all the revenues and all the expenses are reported in the proper period in which they are earned and incurred. Basically, we want to make sure that these financial statements are right. You got to remember, people are making decisions from this, okay? So imagine you had a company and you're not reporting your stuff right. People are going to be pretty upset with you. So without adjustments, financial statements are incomplete and misleading. And again, it depends on how big these adjustments are, but the bottom line is our job, accounting people, and again, for those of you that aren't accountants, at the end of the day, if you're going to be the boss, let's say you're the boss, you're not the accountant, and you go into the bank and you're like, hey, look, we want to get a loan for some new equipment. They need to be able to believe these financial statements. If they don't, do you think they're going to loan you the money? Okay? If they find a lot of mistakes, if they find you're not doing things properly, why would they lend you money, right? Makes sense, doesn't it? Okay? All right, so now we're going to take a look at some problems here. So they have some following transactions for Sky Blue Corporation. They want to know accounting effects, what adjustments are going to be made. So they collected, and this is for October 31st, they collected $2,400 rent from October 1st to December 31st. That's 3 months, which has been credited to deferred revenue on October 1st. So now it's October 31st. They collected 3 months, so that's $800 a month. And now at the end, October 31st, what happens? Well, now our deferred revenue goes down by $800, and now we've actually earned $800 in revenue, right? So we had collected it, it was put to deferred revenue, and now we're going to lower that deferred revenue and count it as revenue. Okay, how about this? We paid a 2-year insurance premium for $1,200, 2 years, and debited prepaid insurance, okay, on October 1st. So we got October 31st, that's 1 month out of 2 years. So we got $1,200 divided by 24 is $50, right? So now we have to recognize $50 of expense. So there you go. Lowering prepaid insurance by 50, and now we have insurance expense of 50. Okay? Use the machine purchased on October 1st for $48,000. Company has annual depreciation of $4,800. Okay, so now it's October 31st. We bought it October 1st. So we used it for 1 month. If annual depreciation is $4,800, divide that by 12, it's $400 a month. We need to show 1 month, right? So what do? We have accumulated depreciation of $400, depreciation expense, $400. Okay? All right. Now, what do the journal entries look like for that? There's the first one. Deferred revenue. We're lowering our liability, and now it becomes revenue. It went from unearned to earned. Okay? So from unearned to earned. Second one, insurance expense. Again, increasing our expenses, lowering stockholders' equity, lowering net income, $50. We're lowering our prepaid insurance by $50. By the way, what's going to happen the next month? Another $50, and another $50, and another $50 until we use it all up. Then finally, depreciation expense, $400. Increasing our expenses, lowering stockholders' equity. Then we're going to credit accumulated depreciation. Contra asset. Contra asset. That's what this means right here. Contra asset, $400, right? By the way, if an asset increases with a debit, a contra. Contra means against. Has to be just the opposite. Increases with the credit. Okay? All right. Now we have independent situations. It says prepare journal entries for the initial transaction on September 30th and on the adjustment required October 1st. Okay? So Hockey Helpers paid $400 in cash on September 30th to rent an arena for October and November. Okay? So they paid $4,000 in cash for 2 months rent. So what would happen on September 30th? They would get prepaid rent for $4,000 and they would lower their cash, right? They basically changed assets. Now, we have an adjustment on October 31st. So 1 month later, 1 month, right? So what are we going to do? We're going to use $2,000 of this, right? So we're going to have rent expense of $2,000. That's increasing our expenses, lowering stockholders' equity, and then we're going to lower that prepaid rent. By the way, how much rent is left? 1 more month for November, right? So there you go. Just have to follow what it is, pay attention to the dates, pay attention to the information, and it's not that hard to do. Okay? How about this one? Superstage shows received $16,000 on September 30th for season tickets that will admit patrons to events that will be held twice, on October 31st and November 30th. So they want to know what happens on September 30th. Well, they got cash, but it's unearned yet, or it's deferred, right? We got cash, but we didn't earn it yet. So what would we do? We'd have cash, $16,000, an asset, and deferred revenue or unearned revenue, which is a liability, $16,000. Now they want to know what happens on October 31st. Okay? So what we're going to do here is we're going to wind up splitting that money, $8,000 for October 31st and $8,000 for November. So we're going to lower that deferred revenue, and now it's going to be earned revenue, service revenue of $8,000. So you see, we're taking this deferred revenue here, we're lowering that. Now that it's got $8,000 left, and what's going to happen? The other $8,000 is going to go from deferred to earned revenue after November. Okay. How about this one? Risky Ventures paid $3,000 for insurance coverage for the 3 months, these 3 months. So again, September 30th, October, November, December. Wow, that's $1,000 a month. So what they're going to do, they're going to have prepaid insurance for $3,000, an asset, and they're going to lower their asset cash. Now they want to know what happens on October 31st. Well, they used what? 1/3 of it, right? They paid for October, November, December. Well, we got to show how much of it was in October, right? So we're going to go insurance expense, $1,000, right? And prepaid insurance, $1,000, okay? By the way, how much is left in prepaid insurance after that? $2,000 left. You'll use that in November, and then you'll use that in December. All right, here, let's see. Magnificent Magazines received $12,000 on December 31st for subscriptions published and distributed through the next year, okay? So $12,000, they got the cash, but they didn't earn it yet, right? So we got cash, $12,000, deferred revenue, $12,000. Now here you have to make the assumption that they're doing it evenly throughout the year because they're a monthly magazine subscription, okay? So in the month of January, that's 1 out of 12 months, right? How much of that $12,000 will they have earned? Well, 1,000 of it, right? So now we're going to lower that deferred revenue by 1,000, and now it's going to be earned revenue, okay? By the way, what's going to happen after the next month? Another 1,000. And after the next month, another 1,000, right? As we earn it, now we have the cash, but as we earn it, then we'll get to call it revenue. All right, so here another one. They had $1,200 for supplies on the books on December 31st, and as of January 31st, $200 of this has been used up, okay? So we're going to show the journal entry. This is where we bought the supplies. So we traded our cash for supplies, and then on January it says we used $200. What's going to happen? Supplies expense, $200. Lowering supplies, which is an asset, by $200. How much is left? $1,000. We used $200 of it. Okay. How about this one? Indoor race ray got $3,000 for 3 races. 1 race in January, the other 2 in March. Okay. December 31st, $3,000 unearned, right? They got it, but the races haven't happened yet. So you go cash $3,000, but it's not earned yet. Okay. What happens in January? One of them's in January, so we're going to split it by a third. We're going to change that deferred revenue by $1,000, right? We're going to take 1,000 of it. It's no longer deferred. We're going to lower that deferred. We're going to lower it. And now, service revenue, $1,000. By the way, what's left in deferred now? $2,000, right? For the other two races. All right, folks, I'm going to stop it right here. It looks like we're going to have one more portion of problem walkthrough. I'll be back in just a minute.